I'm Professor Philip Wolitzer of Long Island University, and I'm going to try and teach you a little bit about understanding financial statements. The genesis of financial statements is the use of accounting and bookkeeping, which actually goes back to the beginning of time. However, the first formal written treatise on that subject was in 1494 by Fra Luca Pacioli, a monk, who put it all together and is considered the father of the modern bookkeeping and accounting and the double entry method of bookkeeping. Actually, there are only 5 classes of accounts, and if you can concentrate on those 5 classes of accounts, you'll find that everything flows from there. The 5 classes of accounts are assets, liabilities, capital, income, and expenses. There are formal, lengthy definitions of each of these, but to give it to you very practical: assets, anything you own, OWN. Liabilities, anything you owe, OWE. And the fundamental equation is expressed as assets minus liabilities equals capital. And actually, that is the balance sheet or statement of financial condition. The next 2 accounts, income and expenses, I don't think I have to explain to any of us. You meet those every day of your life. However, from the formalized standpoint, income minus expenses equals net income. This is known as the balance sheet, statement of financial condition. This is known as the income statement. It's income minus expenses being equal to net income. Now, the balance sheet, we say it's a statement of financial condition because it's a statement prepared at a moment in time. In other words, we could prepare a balance sheet today. We're doing this December 2nd, 2009. The statement of income is actually for a period ended. Dependent upon the size of the entity, we can prepare a statement of income monthly, quarterly, semi-annually, or annually. It's entirely up to the business itself as to when they're going to do that. What we also have to bear in mind is, when do we recognize these? There are 2 methods. One is known as the cash method, and the other one is the accrual method. Cash is easy. In other words, we would only recognize income or expenses when cash comes in or goes out. The accrual basis of accounting says, hey, things happen and cash is not always involved. So when we recognize the transaction, regardless of cash, that's the accrual method. The cash method really can be used by only the smallest of businesses, because the way business is done today, it's done by, I loan you money, you loan me money, I take a bank loan, everything happens, and cash is involved in very little transactions at that particular moment of time. It comes up later when there's settlement. So you have to decide whether you can use cash or accrual. For any business where an inventory is involved, you really can't even use cash. You must use the accrual basis. Now, here's the connection. Income minus expenses equals net income. Cash or accrual, either way. That net income then goes up to capital, and if it's net income, it raises capital. If it's a net loss, it lowers capital. So that we find ourselves in a continuous cycle, you might say. You have income, you have expenses, you then have net income. Net income affects the capital. In a corporation, it's called stockholders' equity. And because it's a fundamental equation, anytime capital changes, the assets and the liabilities have to change to also get themselves into balance. I previously mentioned double entry bookkeeping to you. That comes about because you've got this equation. In other words, in order to keep this equation in balance at all times, when we make entries, we see to it that the entries balance. Now, going back to 1494, Fra Lucia Pacioli utilized Latin terms. The Latin terms, in essence, have been abbreviated to debit, DR, and credit. So the double entry bookkeeping simply says the debits always have to equal the credits. They have to balance. And that's how we keep control and know that we're doing the right thing. So surprisingly, you can have debits equaling credits, but the entry can still be wrong. And yet we maintain our double entry bookkeeping.